HMRC opens thousands of investigations every year into people who file self-assessment tax returns, landing many of them with hefty fines that put their finances at risk. In this video, I'm going to run through 10 really effective and easy ways you can avoid being investigated yourself, and these are applicable to everyone. Whether you're a small business owner, you're a freelancer or self-employed, these tips could save you from unnecessary stress, wasted time and hefty penalties. So let's dive straight in. Starting off with number one of the best ways to stay under HMRC's radar is by filing accurate returns. Sounds simple, but many people make mistakes, and here are a few tips to get it right. So always double check your figures before submitting your return. A tiny typo can cause big problems, and I've seen everything where someone's entered an extra zero on income accidentally and they've not realised until they got a demand for £10,000 in additional tax, to somebody entering savings total instead of the bank interest, causing months of stress trying to sort it out and refile. Ensure your reported income matches your bank statements, your invoices and any other records you have as well. If you're registered for VAT or have payroll, make sure those figures reconcile with your tax return. Using accounting software or even using tools like our free spreadsheet template can help minimize errors. Accuracy is key, but keeping detailed and clear records is equally important. Let's look at how to do that. Next up, at number 2, keep your records crystal clear. HMRC requires you to maintain detailed receipts and invoices for at least 6 years. But this isn't just about compliance, it also helps you prove your case if they ever ask questions. Organise your receipts digitally or in physical folders. Label them, category, travel equipment, utilities, etc. And don't forget to keep records of any transactions involving cash or unusual payments. A clear paper trail can make all the difference. Of course, even with accurate returns and clear records, mistakes can still happen. Here's how to avoid the most common ones. So number 3 is avoiding common mistakes. Many investigations start because of avoidable mistakes, and here are some of the most common errors that I've seen. Firstly, claiming personal expenses as business costs. Remember that holiday in Spain probably doesn't count as market research, nor do your cockapoo costs count as guard dog expenses. Incorrectly using flat rate expenses or allowances. If you're unsure, check HMRC's guidance or ask an accountant. Then we have forgetting to declare all sources of income like side hustles, rental properties or investments. Rental properties is particularly one of the most common mistakes due to common misconceptions and pub accounting tips, such as if you have no profit because the income just covers the mortgage, it doesn't need to be declared. Not true, and personally I would never take advice from someone wearing their beer goggles. By avoiding these, you're already miles ahead in staying compliant. Now, speaking of compliance, timing plays a huge role. Let's discuss why filing on time is non-negotiable. This one's simple, but so important. Meet your deadlines. Number 4 is file on time. For self-assessment, the key date to remember is January 31st for online submissions for self-assessments. Filing late or missing deadlines can lead to automatic penalties, which can make HMRC in turn take a closer look at your return. To stay on top of this, set reminders on your phone, your calendar or accounting software. Better yet, aim to file early. This not only avoids a last minute rush, but gives you time to fix any errors. You don't have to pay your tax early, but at least you know what it will be. So far we focused on proactive steps, but what about transparency and handling errors? Let's cover that next. Number 5 is be honest and transparent. If you're ever tempted to hide something from HMRC, don't. The risks far outweigh the rewards. Honesty and transparency are key. If you're unsure about something, get advice, don't guess. If you do discover an error after filing, HMRC has a system for voluntary disclosures. Coming forward early can save you from harsher penalties or investigations down the line. Now, let's talk about some practical tips to stay off HMRC's radar altogether. Number 6 is to stay below HMRC's radar. While there's no foolproof way to guarantee HMRC won't investigate, there are things that you can do to reduce the likelihood. For example, avoid cash-heavy transactions without proper records. Don't make sudden, unexplained changes to your financial patterns, like if you consistently declared an annual turnover of, say, 300,000 for the past 5 years, then suddenly a turnover of 150,000 in the most recent tax year without explanation. And if HMRC does reach out with queries, respond promptly and professionally. Even with all of these measures, having professional support can make a big difference. And here's why working with an accountant matters. Now, let's talk about the value of working with a qualified accountant. A good accountant can help identify risks, ensure compliance, and add credibility to your tax submissions. Of course, it'll cost you money in accountancy fees, but it could save you thousands, so it's definitely worth considering it. Think of it as an investment in peace of mind. They'll help you spot errors, claim everything you're entitled to, and present your finances in the best possible light. But even with professional help, you should know how investigations work. So I want to touch on a few lesser known facts. So at number 8, we have investigations without income. Here's something many people don't realise. HMRC can open an investigation even if you haven't declared any income. It might happen if they suspect undeclared earnings or cash transactions. For example, a few years ago, HMRC required e-commerce platforms to provide lists of all their traders. And before that, they were collecting lists of rental landlords from letting agents and matching them with land registry. If there's a mismatch between you, your bank account activity, for example, and your declared income, HMRC might take a closer look. It's a reminder to always be transparent and ensure your financial records are complete and accurate. And also see our video that goes into the ways people trigger self-assessments without knowing it. Now, let's take it one step further and talk about the financial implications of an investigation. Another important point to remember at number 9 is investigation costs even without tax issues. An important point to understand is that HMRC investigations can be costly. Even if no tax issues are found, HMRC can charge for their time spent on an investigation, including hourly fees for examining records, meetings, correspondence. And that means you could face significant costs even if you've done everything correctly. This is why having professional representation during an investigation is so critical. It ensures the process is handled efficiently and can help reduce unnecessary costs. So what should you do if you ever face an investigation? That's where working with a good accountant comes in. And lastly, at number 10, get tax investigation cover. If the idea of a tax investigation worries you, don't panic. Helpbox UK have partnered with Vantage Tax to provide comprehensive support if HMRC ever comes knocking. Now, just to be clear, this video is not sponsored by Vantage Tax, nor have they paid us any money to promote their product on our channel. We just think they offer peace of mind and are good at what they do. Their service offers up to $100,000 worth of cover for professional fees incurred during an investigation, and this includes corporation tax and income tax full or aspect inquiries. It also covers PAYE and NIC compliance checks and disputes. It covers IR35, employment status and CIS inquiries. It covers VAT compliance checks and disputes as well. It also covers national minimum wage and national living wage inquiries. It covers inheritance tax, stamp duty and Scottish tax inquiries. And additionally, you'll have access to Vantage's employment, health and safety and legal helpline for advice on issues your business might face. Their team of experts liaise directly with HMRC. They'll handle the process efficiently and ensure your rights are protected. And if you're interested in our support with Vantage's cover, click the link below to book a completely free discovery call with one of my team. Lastly, I want to quickly share those common investigation triggers I mentioned earlier. So HMRC uses a system called Connect that cross-references over 1 billion data points from banks, companies and government records. So if something doesn't add up, chances are they'll notice. For example, if you have discrepancies between the income you report and third-party data like PAYE or VAT filings, if there are large or unusual expense claims that seem out of place for your business or your job role, they'll notice. Sudden changes in income or profits compared to previous years, although if you have a seasonal business, they do take this into account. Rental property income not showing for a second property under your name on the land registry or on a letting agent list, they'll notice. Repeated filing errors or late submissions, again they'll notice. And if you're in a cash-heavy business, this can also raise a red flag regardless. Before we wrap up, let me share a quick example. A small business claimed a director's personal car as a business expense without proper justification. It raised a red flag, and sure enough, HMRC launched an investigation into what it was used for and why. Simple errors like this can cost you thousands in fines and lost time. So don't let small mistakes become big problems. If in doubt, ask for help. If you found this video helpful, please give it a like and subscribe for more tax saving tips. Share it with any business owner you know who might need these insights. And if you need professional help, feel free to reach out.